Well, good morning, good afternoon, too early. Good morning, good afternoon, and a very warm welcome to everyone joining us today. My name is Barbara Buchner, and I'm the Global Managing Director, Climate Policy Initiative, and it's a real pleasure to be here with you today. I'm very excited to be kicking off the new year with a very timely discussion on the role of equity, which remains a crucial but underexplored component of climate finance, with a huge potential of really scaling up investments. So in today's session, we will discuss key insights from our recent report, the Clean Energy Equity Investment Gap, which was prepared by CPI, GFANZ, Allied Climate Partners, and the three Cairns Group with analytical support from Wood Mackenzie. I'm very happy to be welcoming Mary Shapiro, the Vice Chair of GFANZ today for opening remarks, and Ahmed Saed, who is the CEO of Allied Climate Partners, followed by a very short presentation of the report's key findings by our core team here. We will then move into a moderated panel discussion where I'm joined by Dario Traum, who is the Managing Director and Head of the Climate Intelligence Unit at Macquarie Group, Marco Serena, who is the Chief Sustainable Impact Officer at the Private Infrastructure Development Group, and Rodrigo Salvador, who is the Global Head of Strategic Financing Partnership at HSBC Infrastructure Finance. Please, if you have questions, submit them in the Q&A box at the bottom of your screen, and we will try to cover all of them, both in the chat and directly from our speakers following the panel discussion. But with that, it's my real pleasure to be welcoming Mary Shapiro to kick us off. So Mary, great to have you here, and over to you.
Thank you so much, Barbara. And on behalf of GFANZ, thank you to the teams at Climate Policy Initiative, Allied Climate Partners, and Three Cairns Group for being such excellent partners on this work. We started this effort together around 18 months ago, following discussions in the World Bank Private Sector Investment Lab. The lab consistently heard that equity is a critical component of capital formation for emerging market-oriented projects and funds, but that it's underutilized by development finance providers who have traditionally focused on debt financing. The lab recommended that in order to mobilize private capital at greater scale, the IFC should grow the volumes of equity it deploys. It should particularly focus on deploying catalytic forms of equity and either take higher levels of risk or accept lower levels of return. Building on the lab's recommendation, GFANZ worked with CPI, ACP, and Three Cairns to further develop this work by constructing a data-driven case for catalytic equity and sharing it with development finance institutions beyond just the IFC. With the release of our report, we have now made public two crucial pieces of data. The first is our estimates of the equity finance needed, broken down by sector and region, to meet our climate and development goals. The second is the portion of that equity that should be catalytic to meet these goals. This work is grounded in detailed analysis, building from widely used transition scenarios and over 70 real-world transactions in emerging markets. This work provides timely recommendations on how we can do more with less, as levels of overseas development assistance decline, but climate and development needs do not. I hope that providers of catalytic equity, including development finance providers and their government shareholders, will use this work to more effectively and efficiently channel their limited resources. And I look forward to working with them and our other partners on these important issues in the months and years to come. One such partner is Ahmed Saeed, CEO of Allied Climate Partners, whose leadership has been critical to our shared progress on this work. And I am delighted he is here to share some remarks. Ahmed, over to you.
Thank you so much, Mary, and thank you for really getting us started here. And I think really what you said, how can we do more with less, is even more important today. And Ahmed, sorry, I already you were starting to kick us off with your vast experience. So let me immediately hand over to you and let me hear from you some of the high-level findings as well from the report and your very important role. So over to you, Ahmed.
Thank you, Barbara. Thank you, Mary. Thank you to your colleagues at CPI and at GFANZ and our co-collaborators at Wood Mackenzie and Three Cairns Group. This is a really important piece of work. and I'll make just a few points. The first is just how happy I am at the beginning of the year to be talking about the financial instrument that represents the beginning of capital formation. Equity is the first thing we need to mobilize capital, and so in some ways it's appropriate we talk about it so early in the year. A few high-level points. The first, emerging markets are where the climate battle is going to be won or lost. In 2050, the IEA estimates that 70% of emissions will come from emerging markets. And so we really do need to focus on mobilizing capital and technology into these regions. Second, and I think this is well known and understood, the majority of that capital must come from the private sector. The third point, which I think this report makes very clear, is equity is the backbone of bankability. If there's no equity, there's no debt. If there's no debt, there's no project. This report, as Mary noted, estimates that a net zero scenario would require $375 billion annually of private capital, or in other words, a $215 billion annual equity gap in 2035. That represents a fourfold increase from today's levels. So we need a lot more equity, and we need it much more quickly. One of the other items this report highlights is the power that catalytic equity can play in mobilizing equity. The report notes that $1 of catalytic equity has been shown to unlock $4 in intermediated equity, $9 in project level equity, and $30 in total project level CapEx once debt has been leveraged. And so this report, I think, plays a very important role in highlighting the importance of emerging markets, the importance of private capital, the importance of equity, and the importance of catalytic equity as a tool to get the engine of capitalism going with respect to this enormously consequential global problem. The organization that I have the privilege of managing, Allied Climate Partners, was created to address precisely this gap, the shortage of scalable catalytic equity for climate solutions in emerging markets. We partner with governments, with DFIs, philanthropies, and the private sector to deploy equity into funds that are building great climate businesses across emerging markets. We're excited about bringing this report into the world with our partners and believe it reflects our core convictions that public and concessional capital must be used highly strategically, and that equity, especially catalytic equity, is one of the most powerful tools we have to unlock private investment and accelerate the energy transition. The last thing I would just note is I had the privilege of working for a Secretary of the Treasury who used to say that capital is a coward. We need capital to do many things. Equity and catalytic equity are the least cowardly forms of capital. We need more of them so that we can crowd in the others. Thank you.
Thank you so much, Ahmed, for really kind of highlighting the key points of the work that we have done together, but also of really kind of the importance of thinking about catalytic equity really as a powerful tool to unlock and get climate finance to scale. So I'm looking forward to hearing more about all the experiences, as also from Allied Climate Partners, where you clearly have been pioneering lots of them, working from others that are joining us today for the conversation. But now it is my pleasure to hand over to our core project team from our various organizations that have been working very hard on this report here, and who are going to give us an overview of the key report findings. We have Ben Attia, Sam Shepard, and our very own Constanza Strinati. And so let me hand over to you.
Thank you, Barbara. We'd like to take a few minutes now to walk you through some of the key findings of our analysis. Presenting today are some of the people who have worked on this, namely Ben Attia, Principal at Allied Climate Partners, Sam Sherburne, Director for Capital Mobilization at GFANZ, and myself, Costanza Strinati at Climate Policy, Manager at Climate Policy Initiative. So let me first reiterate why this work is important. In an environment where public finance is increasingly scarce and trying to tackle several seemingly competing objectives at once, public finance providers are under constant pressure to do more with less. In this context, our analysis provides evidence to help rethink equity and catalytic equity as an effective tool to mobilize larger amounts of private capital, especially towards energy transition goals in emerging markets and developing economies. As we know, equity is a critical component of capital formation and an essential tool for scaling projects and companies. And yet, as we will see later on, it remains underutilized, with climate and development actors historically focused on debt financing. So to overcome this, our analysis aims to really highlight the opportunity offered by equity and catalytic equity to scale capital in EMDEs. And we do so by providing estimates of total investment needs by technology and region to look at where the opportunities are, by sizing the equity investment gap under a net zero scenario to give a sense of the challenge, and then by defining and assessing the role that catalytic equity can play in capital formation and in filling this gap. So in the next slide, as a first step, we estimated future capital requirements, both debt and equity, under two scenarios. A base case in blue here in the graph, which assumes the energy transition will continue in line with observed policy and technology trends, and a more ambitious trajectory in green, aligned with net zero goals. As you can see from the graph, annual capex will need to rise at a compound annual growth rate of 13.1% under net zero. And this is more than twice as fast as the base case scenario and over 3 times faster than historical trends in orange to the left. So if we can go to the next slide, in absolute terms, you see here on the left that annual capex will need to reach 1.3 trillion by 2035 in the net zero scenario. Of this, 375 billion will have to come from equity, an amount which is around 4 times higher than today's equity investment levels in EMDs. If we then compare equity capital needs in the two scenarios, like we do on the right here, we can see that under a net zero scenario, we are left with a 215 billion annual equity investment gap to fill. So the real question is, how do we close this gap effectively to deliver the energy transition in these countries? And to answer that, I will now pass it over to Ben.
Thanks, Costanza. The good news is that this equity gap, this $215 billion, is relatively concentrated. So if you look at the pairing between different sectors and different regions in the modeling that we did, there's about 90 of them, and the top 10 account for about half of this gap. There are some areas, these are the areas where there's incremental investment need beyond the expectations that is substantially higher than where we see the current trends today. And that means that those are areas of substantial opportunity. Actually, even within those top 10, the 3 largest are all in India. They're power generation, buildings, and transport sectors. And that's about a quarter of the entire 215 billion that will appear by 2035. Why is this useful? Investors can use this data set as a high-level guide to begin to identify some asset allocation opportunities. And those should be matched to their size, their risk tolerance, and their future policy expectations, which may be different than what we've modeled here. But some of these corners of the transition represent really high growth, high potential opportunities for both large asset managers and capital allocators, as well as for smaller, more boutique firms that have a stronger local presence. And a strategic focus on some of these areas where there is a gap and where you would have kind of differentiated policy expectations. Those will come with differentiated expectations on the growth of equity as well. Next slide, please. As was mentioned earlier, we've seen some early evidence that suggests this tool of catalytic equity could be potentially very powerful to mobilize other investors into these parts of the equity gap. And this is what catalytic equity essentially is capital that mobilizes other investors by reducing their risk or enhancing their return. And by crowding in that additional capital, catalytic equity can accelerate capital formation. It can help projects, companies, and funds achieve commercial viability. And by blending this capital into deals, investors can actually unlock or scale projects or business models that might not otherwise happen. We use a term to describe that called additionality. And catalytic equity can have some very high additionality and very high mobilization when it's used in a well-targeted way. And in fact, when it's done well and it succeeds, it can actually create a demonstration effect that can help build confidence among commercial investors who would have otherwise had perceived risks keeping them out of the market. and then also potentially eliminating the need for more catalytic equity to be deployed in that same project sector or region in the future, and allowing commercial capital to come in on its own at commercial terms. We also think that there are some very, very early signs of catalytic capital having other positive effects beyond mobilization. We've seen instances where the presence of catalytic equity can actually compress deal timelines and help senior investors close transactions faster. It can reduce some bottlenecks in the flow of capital where investors have typically been mismatched with some of the risk profiles in the market. And we actually think it might even be able to induce policy and regulatory improvements by highlighting or spotlighting market inefficiencies and providing policymakers with increased confidence that when they do change policy, private capital will flow in response to that. Next slide, please. As was mentioned before, we did look across as many of the transactions, blended transactions using catalytic equity in emerging markets as we could find. We think there are about 70 out there in the world. And we find that the mobilization potential, particularly when used in intermediated structures, like a fund or platform investment, are potentially very high. So as was mentioned before, that's about a 4x multiple at the fund or platform level. When it's invested into a project and also receives co-investment, that's about 9x. And the median value, when you include leverage, could be as high as 30x, and in some cases, substantially higher. And so if we just think through a simple example there, a $25 million catalytic equity commitment could raise $100 million in senior equity. That's the 4x. If it gets matching co-investment at the company level, that would become 250x. And then with debt at a typical 70-30 ratio, that could be about 750 million mobilized off of a relatively small investment. Of course, claims on mobilization can be subjective. This is more of an exercise to demonstrate the fact that a little bit of catalytic equity can go a long way. And in a world of retreating ODA, that is a good news. It means we don't need a lot of catalytic equity to close the gap. Our estimate, using the exact same levels of concessionality from catalytic equity that we observe historically in this data set, would show us that about $25 billion a year could help close the equity gap by 2035, alongside many other policy measures, technological improvements, and other changes. And we estimate that if the use of catalytic equity gets more efficient and more well-targeted, that number could actually be as low as around $12 billion. Those are preliminary estimates, but we think that they give a directional range to show that the overall need for catalytic equity is actually quite small compared to the overall size of climate finance needs in emerging markets. Next slide, please. And I'm just going to take a quick moment to step back and summarize how we arrived at these numbers. As Costanza mentioned, if we take the future expectations of deployment and future expectations of technology costs, that's how we get our overall CapEx numbers. By 2035 in a net zero world, that's that $1.3 trillion number, which is similar and in range of other estimates from the likes of the IEA and the IH-LEG. We used climate finance flow data from CPI and project finance data from Wood Mackenzie to estimate where the current debt equity splits look like today. So for projects that are getting financed now, is that 70-30? Is it 60-40? And we can do that in a very robust way at a very granular level of detail across about 50 technologies and the entire emerging market universe. Then we can project how that debt equity ratio is going to change over time, based on future expectations of technology deployment and technological maturity, economic growth, and macroeconomic conditions. And that shows us how that equity share will erode over time. Typically, as technologies scale and as markets get more mature, bank finance gains increasing prevalence in a capital stack. And so we expect that over time, there are different ways we can expect the total equity need to be lower as the risk profile changes in the future. And as Costanza mentioned, we take the gap between that net zero future and that base case expectation as a one way to represent the equity gap. And then from there, we can back into current levels of concessionality and a more optimal level of concessionality. There are some more technical details on how we did all of this, as well as some data that you can download with the technical appendix of the report at the end of the in the back half of the report. And we're also very happy to discuss this in the Q&A section. But I'm going to pass now to Sam to talk through some of the implications of the work.
Thank you, Ben. So as we've learned so far, each dollar of equity and catalytic equity has a really disproportionate impact in terms of the amount of private capital that it can mobilize on commercial terms when we compare it to other instruments. And we know that relatively modest volumes of it, if our analysis is correct, can help contribute to closing the financing gap in EMDEs. So we wanted to take that implication and compare it to some of the data on asset allocation that we see from the major public development finance providers. What we see is this tool isn't as widely used as it might be. As Mary said, we started this work coming out of the World Bank's Private Sector Investment Lab. If we look at their private sector financing arm, the IFC, the largest development finance institution for the private sector, it only deploys a relatively small share of its investments as equity. And that share has actually fallen year on year. It's gone down from just over 20% around a decade ago, down to around 8% per year today. And across all of the MDBs, the DFIs, and the vertical climate funds, we estimate that equity deployment for climate mitigation, the scope of this report, is only around $3 billion per year over the last few years. It's far below the levels that, as we've discussed, we need to see. Catalytic equity is much harder to measure. It's not publicly reported because it's not a concept that before this report was widely used and understood. But what we did is we took some transaction-specific data from different MDBs and DFIs and tried to produce an estimate. And we think that's around $650 million per year of catalytic equity for these sectors is currently flowing into emerging markets. And that's well short of the $12 to $25 billion that we need. Now, there's really good reasons for this. As we said up front, the MDBs, the DFIs, or the MDBs rather, grew out of being sovereign lenders, and their private sector arms and bilateral DFIs were created later, but for many of them, debt remains a primary focus. These institutions also deploy capital under shareholder risk and return expectations. Equity is more volatile and is riskier compared to making a debt investment, and therefore requires higher expected levels of return to compensate you for that. Several institutions listed on this slide raise their funds in the capital markets, and so they need to maintain their credit ratings. There are high capital charges associated with the deployment of equity, particularly very junior equity, and so that can discourage growing equity allocation even further. And finally, team incentives matter too. Equity deals can take longer to originate, and so where there's annual deployment targets, teams may favor, for very good reasons, dispersing debt instruments faster rather than equity investments slower. And that helps explain some of the picture you see between different providers. And I would call out the GCF's flexible capital mandate as a reason why it's able to do more equity, or the fact that BII doesn't need to leverage its balance sheet to raise funds as a reason that it deploys more equity. So given all of that, what does this mean for development finance providers? Quite clearly, we believe that climate and development finance providers of all forms should focus on growing the volume of equity and catalytic equity that they deploy and using it to crowd in private sector investors on commercial terms. If they're going to do that, they need to engage very closely with their shareholders and with their treasury and risk teams, particularly because equity is a riskier asset class. There are some clever ways that we're seeing them starting to do that. It might be, for instance, putting equity into a fund or a platform to diversify risk rather than always going into a particular project and doing equity direct. It might also mean allocating equity pari passu, so being in the same position in the capital stack as a peer investor. We're also starting to see some innovation around off-balance sheet mechanisms. So following the World Bank Labs discussions, around a year ago, IFC launched something called the Frontier Opportunities Fund, where they took $100 million of their retained earnings, turned it into first loss equity, which they can deploy, with the aim that each dollar coming out of that fund would mobilize a further $5 of IFC mezzanine equity on top, and then a further $10 of private capital on top of that. And IFC is setting out plans to grow that facility even further using shareholder and philanthropic support. And all of this will only work if all of the capital from climate and development finance providers goes out faster and is easier to access, so there's less friction in the market. As we said up front, as public development finance becomes increasingly scarce, we do need to do more with less. And so we think it's important that where catalytic equity is used, it's done so efficiently and effectively. And therefore, as this tool, which is relatively scarce, is used, we need to learn from its use in the market, including understand the risk and return profile that it has, and if that is what we would expect. There are some areas of work which we at GFANZ and several of the partners on this call hope to take forward to answer some of these questions in the future. So to give you some examples, figuring out what the minimum volume is of concessional finance that you need in a structure, and figuring out how to use it as judiciously as possible to bring a structure to bankability, or mapping additional sources of concessional finance and increasing the transparency available on those to potential users ex ante. And finally, we think it's really important that the evidence base in this report is shared with those who may provide catalytic equity to the market. We hope that this webinar has been a first step towards that. We look forward to your questions, but with that, I'll hand over to Barbara to take us into the panel discussion.
Thank you so much, Dem and Bennett, Costanza. I think really good just to see all the work that went into this report and really having this evidence base. As you just said, I think for us it is important that we can start from learning what is going on, where is the real potential, where are the gaps, but then really thinking about how can we use the innovations that we see in the market and the information that we have to really build on that and further help scale equity as a powerful tool. And as Costanza said, also to rethink really the role of equity as an effective tool. But with that, I think let's continue to learn from the experiences in the market. And let's go to our panel discussion, where I'm very excited to be joined by three experts and practitioners in the field. And so let's dive right into it as we have limited time. And again, I do encourage all of you to send your questions in the Q&A box, so we are sure that we are able to respond to those both in the chat and in the discussion. But Dario, let me actually start directly with you. I think as we've just heard here, the report shows that the lack of equity and catalytic equity continues to be a key constraint holding back clean energy investments in emerging markets and developing economies. So I'd love to hear from you a little bit more how Macquarie has been working to overcome that challenge. So Dario, over to you.
Thanks, Barbara. Yeah, I think the energy transition has come a long way. We've had over $2 trillion of investment in that scene last year, and EMs is certainly less than we would want, but it's a not negligible part. And I think with that maturity comes the fact that at this stage, if you want to make an impact in this space, you really need to be able to operate at scale. So generally, we've tended to move away from individual projects towards more platforms that can do repeated projects. And that's where you need equity partners that can work with you to scale the projects and grow these platforms. And unfortunately, that's probably where there's been a bit of a gap, in particular in emerging markets. The kind of patient institutional capital that's needed to scale platforms competitively is still often quite reluctant to go into emerging economies, especially the smaller ones. Where they have had some exposure is probably in emerging market bonds, in particular sovereign bonds. And despite the aspiration of MDBs to work with this institutional capital and help it move more into emerging markets, the kind of sort of project finance and debt focus that they've had historically is not really suited to work with these counterparties. On our side, how we've overcome this challenge and sort of worked with our in the funds business institutional partners in emerging markets is that we've set up regional funds that have a tolerance for EM exposure. So you have a diversified regional fund that's overweight high income economies, but that can go into EMs. And we've had some really positive investment experience, especially in the large emerging markets on a purely commercial basis. But that's a status quo that's probably not doesn't meet the need and challenge that we're trying to solve for and what we've been talking about today. And so really, if you take that current context and you think about how MDBs can help to move the needle, it is by moving more into this equity space and helping catalyze and establish these platforms. And we've had a really great opportunity to build an experience in that space by partnering with the UN GCF recently to establish a commercial EV financing platform in India. And that is really a market and a sector where you need scale to move the needle. And there the GCF is, as I mentioned, coming from the establishment of the platform, put $200 million of junior equity, very early stage and been very supportive. And that's allowed us to last year raise $205 million of private equity commitments from top tier institutional investors. So that immediate follow-up commitment has been really successful. And now we want to grow that platform to at least $1.5 billion through follow-on financing, and that platform will live on. But importantly, we're also confident that the GCF will be able to recover its capital, meet its investment objectives, and then take that equity and deploy it to other impactful projects. So that's where we're really hopeful. And maybe I'll just go back to Sam's comment earlier. Yes, equity is a big commitment from MDBs because it carries stronger capital charges. But the good news is if it's deployed well and the risks are managed appropriately, you can get that capital back and put it into work in new projects with a return which hopefully grows the overall equity stack. So we're really hopeful about the instrument, but we're conscious that it's very early days relative to how big the challenge and the opportunity is.
Thanks so much, Daria. Hopeful about early days, but at the same time, I think, what you also said, like how can we move from projects to platforms? How can we really think about using that scarce capital from MDBs and others more effectively? I think it's really important. And I think the example that you brought, and we obviously did look, as Sam also showed in the slides, also in the potential offered by the GCF and its portfolio, I think is really important. So I think thinking about how can we build on those experiences and really highlight them, what are the benefits, and therefore hopefully make sure that we replicate more of that and scale those parts. But Marco, let me come to you. Pitch obviously is one of those providers of catalytic equity, and obviously we have profiled you in the report as well. And there's a number of transactions. I recall the one which is Golomotti Solar. But I'd love to hear from you a little bit more. Why does Pitch choose to deploy this form of capital, and what are some of the conditions that help to make sure that these investments actually succeed, and so we can share the good lessons? So over to you, Marco.
Thanks, Barbara, and it's great to see this report at this start of the year. Really, we've been talking about this space for a while, so it's great to see it recognized. And the reason why we started working in this space is the fact that the objective that we had was always to move capital to emerging markets, accelerating transitions. Now, in order to do that, you need to build portfolios of operating assets, and you need somebody to go in first. When government starting opening up to private sector for the provision of clean renewable energy around 2016, 17, 18 in many countries, then it took a lot of courage to go in. And I think at that space there was some capital ready to deploy, but there were no projects. And so that's exactly why we started going in. And there's an upstream part, which is your preparation work that you need in order for governments to work with private sector on the regulatory environment. But then there's that early stage risk. So two examples. One is featured in the report, which is Golomotti. In 2018, we invested in what were the first two solar private IPPs in Malawi. One of them was Golomotti. At the same time, we were doing the same thing in Vietnam. And the story was very similar. So in Golomotti is a small project, relatively small project, is a 28 megawatt project. It was about the demonstration effect and demonstrating that could work. We put in 2 million equity, and at that stage is early stage because you don't know if the project is ever going to see the light. So it's about sharing the risk rather than accepting a lower return and being patient, which was one of the things that was mentioned earlier. And then once when we realized that the project stacked up, so we went in with JCM, a private developer, and that was our model. So go in at a very early stage together with a private sector partner to share the risk with them and then demonstrate that the project has legs. Once that happens, then you need to put a bit more equity in, which is a little bit more secure than the first that you put in there. And that would unlock afterwards either the debt for construction or, in the case of Golomotti, refinancing that came after. And the proportions that the report mentions really resonate with what we see. So initial 2 million, then we put in 8 million that attracted 25 million in equity and then refinancing. If I take Vietnam, we put in an initial 10 million of early stage equity into one of the first 163 megawatt power projects in 2018, when there were virtually no solar projects at the time. and a project that cost about 160 million. So a fraction of it, then we put in a bit more equity and that attractive private sector. The difference between Malawi and Vietnam has been in the exits and in what happened in the market, but maybe we can talk about that in the next round.
Fantastic. Thank you so much, Mark. I think what you just said, like really making sure that someone has the courage and make sure that there are demonstration effects and like really showcasing how you can come in at an early stage, partner with private partners, and then really share the risk and think about how can you then replicate what's working and showcasing that projects have legs. So I think Ben said that we saw about 70 catalytic equity transactions. So again, I think kudos to you and others who are really showcasing and demonstrating that. But let me now come to those private partners. So Rodrigo, it's great to have you here. And I think also, as Ahmed said at the beginning, the report highlights the importance of strong equity in improving bankability. So just from a lender's perspective, what are the characteristics of equity structures that most effectively enable banks like HSBC to support clean energy projects in emerging markets? So over to you.
Thank you so much, Barbara. And I think it's great because I took the job, 4 months ago, and I've been in the Gates Foundation. I've been in the Gates Foundation. I've been in multilateral development banks, right? And now I think, I'm the commercial bank. And I think it's a great point that you're making about the question about what it makes a commercial bank click, right? And I think, I don't know how many of we have attendants here which actually are looking for those answers. And I have to say, I found, the economics and all that, we all know that, right? But I think, I wanted to bring 3 points in my mind, which I think make unique that perspective from the commercial banks. Well, the commercial banks is our clients, right? So are really client-centric. But also, we are not niche investors, right? So going into this, and again, the first thing I would say is to Agne's point at the beginning, we really look at sort of the confluence between equity and debt, right? So we are having the handshakes between both. We see equity as a precursor of debt, right? We have our program, it's called Next Zero Accelerator. It's an equity program, but we are looking already when we get into an equity investment, what is going to be our debt investment are going to come after. So the main thing that we are looking right now is how we do that sort of build that cross-section, of things and how the things back to each other. So number one, what we are looking at really is finding the gaps in that value chain. I think that it's a lot on venture capital right now, but we really want to be working on that missing middle, which is what happens next, how we go to from venture to grow stage. So number one, I think, what we are looking for in the market is that type of thing. We think that, one thing in the report is great. And I think that the other aspect of this, they are not equity, all equity investment are made equal. They are a stage of life, which I think is very important to put there. So for us, it's a little bit, and why? Because again, we are looking for growing markets, growing partners that are going to help us, and we are going to be able to pump in debt in 3 years' time, right? 3-5 years' time. So I think that's important. The second one is, we also came out in the report, is we take an ecosystem view of investment. It's not that we are looking at a fund in itself. If you are looking, for example, to make a fund that actually is going to accelerate deployment of technology, that requires a regulatory environment, that requires other type of things that actually are making. So it's not about the economics of the equity deal in itself or the platform. It's about what is actually surrounding it. If I'm going to be deploying in the Middle East, and I saw, the report very important. I mean, the Middle East has a lot of energy about that now, but it has a lot of things that actually to incentivize investors to deploy and accelerate technologies in the Middle East. So you need to be able to do it. And that, I think, takes me to the third point, which is you need different investors. We like a structure where you have different investors in the mix. So you have public investors, you have private investors, right? You have and when I mean public, you might have NDVs, but also public, government institutions going there. We talk about things in the Middle East, again, you have these institutions that are willing to put there. And why? Because each of them bring different parts to the deal. Everyone can be, for example, the NDVs, not only bring the money, but also the technical capacity, the expertise, the leverage, the local content, the local knowledge, right? So my sense is that it is. And then from our perspective, we are looking to develop relationship with each of the different stakeholders, with the portfolio companies, with the GPs, and with the LPs. So, we really are looking, in order to do that. So I would say these are things that my sense is like very different from our side. I would say that also on the report, we see a lot of things also in Southeast Asia, right? I know. And then I think, my sense is there is a nuance in terms of, again, the government, there's an important role of the government, as I said, in promoting these things, in attracting, in the pooling, right? If from the Middle East, you have a lot of push investments, but to pull them in, there will add a lot of things that we can discuss. And we can discuss that in the second round. Over.
Fantastic. Thanks so much, Rodrigo. I think, particularly this ecosystem view and the role of all the stakeholders in the ecosystem, but I think very importantly the governments as well. So I think I hope they're listening, and we certainly will make sure that we continue this conversation. But I very much like, I think you already highlighted also some areas for some future work, including going deeper into this stage of life, the value chain approach. So where are the gaps and how can you really think about that more in a more structured way. So thanks so much for that. But Marco, let me come back to you. I think both through the example that you shared, but also through what we have highlighted in the report, you can see that catalytic equity can grow in private capital when it's structured well. But given all the various kind of transactions that you've had, I'd love to hear from you. Are there any design principles or approaches that you think are most effective in building this ecosystems, the sustainable markets, and attracting follow-on investors across the ecosystem, as Rodrigo just said? So, Marco, over to you.
Sure. And the first point is really to look for assets and develop assets that make sense economically and commercially. And then I think is the very first point. And also build them to high standards. I think these are really the foundations. It's easier said than done. That very early stage is often a very lonely space where we see developers retreating or reforming and restarting businesses and rejoining alliances. And so I think being with them is really important to make sure that the standards are high, because this is going to pay back. The other thing we've seen is part of the work is really about demonstrating the bankability of the investments at the project level or of the fund. And a lot of this is really doing work that we're not paid for, and that's where the patients come in. So, for example, when Malawi decides to do the first solar IPPs, there's no legal template. So we need to work on those legal templates that then become the templates for all other coming back. Now, unfortunately, there's not many more Malawi power generation solar power generation that happen afterwards. But in the case of Vietnam, for example, the power purchase agreement of Vietnam was largely considered unbankable in 2018. And we decided to be patient and work on the legal adjustments that were needed. It was unbankable also for MDBs at the time. And then if you see what happened afterwards, construction in 1 year, sold to Japanese investors in 2 years, 16 gigawatt of solar now in Vietnam. In Malawi, very different story, slower construction, but still successful operation after COVID. And private sector capital that came in from different sources. In the case of Malawi, we made a sale agreement last year of our share in the Golomoti plant to a local insurance who needs, or Vision Malawi, who needs local currency guarantees. So I think that the message I've got is that private sector will come at different stages according to the risk appetite, but also private sector has got different colors. And so, very commercial investors in Vietnam looking for diversification in the region. And then a local investor who looks for local currency revenue in Malawi. I think this aspect should also be thought about. And the last point I would make is scale. So one of the issues we've got is how do we accelerate the velocity of capital recycling, which is also a point that is well made in the report. And I think that the key thing there is we all worked on funds, but the reality is that it takes time and it takes some form of catalytic capital and patience also in some of those funds. So I think it's really exciting. We're reaching a point where there's enough operational assets to start forming these funds, start transferring these assets. And I think that's where I look at things with optimism going forward.
Fantastic. Thank you so much, Mark. I think this last point, like maybe we are at the tipping point, maybe there are, I think we are certainly also through the report and the work here trying to highlight the potential. So maybe we are getting there, but I think that the previous point you made, what is needed in order to make, success happen. And I think thinking about some of the backbone behind some standards, some templates, some standardized structures that maybe can help replicate faster and really think about how can we do that, maybe in a more regional focus still, because obviously the regions, geographies are different, but still I think there is some very good points there. So thanks so much for that. But Dario, let me come back to you. And we've heard a lot already today about the World Bank's Private Sector Investment Lab. Obviously, Macquarie is a member of it. And you work very closely with a number of public development finance providers. So I'd love to hear from you a little bit. What would you like to see from these providers as they seek to scale their equity and catalytic equity deployment? So over to you.
Thanks. Yeah, I'm glad you distinguish between equity and catalytic equity. And obviously, even the catalytic equity part comes in many forms. And in the report, there's some case studies that shows how different that is. And wanted to call out the great work that Ahmed and the colleagues at Allied Climate Capital Partners are doing, because that's much more early stage and highly catalytic, and it's more the philanthropic actors that have been driving that. But focusing on the MDBs and what we'd like to see opportunities to do more with them. I think they have historically probably had more experience deploying equity than catalytic equity, and quite often it's been on quasi-commercial terms. And that's players like the IFC, for example, that has done a lot of played a really important role in deploying equity to companies in emerging markets for a long time. But generally, when they've been working with partners and managers in this space, it's tended to be smaller ones, and that can come with its risks. And when you think about the scale of operations that we're describing here and the emissions reduction challenges that we're trying to tackle, and there too, the report has a nice list of by country and by sector what the equity mobilization gap is for each of those. You kind of need to be able to work with players that can operate at this scale. And generally, we probably haven't seen sufficient collaboration in that space. And I think Marco's comments is quite interesting to think about whether it is also that there haven't been that many assets that have yet matured enough to reach that point. But if you want to start the journey early and create these assets, which I think is our thesis of what's needed in this space, you really need to bring all the players that can work together at this multi-billion dollar scale across large economies or regions together to work together more and build the structures from the get-go. And to date, that just probably hasn't been happening that much. We've probably done more project to project or very specialized smaller fund initiatives. And clearly, MDBs have a big challenge because they have so many things that they're trying to solve for, not just climate mitigation, but all the other development objectives, and in so many regions and country programs that they're trying to deliver on. So by definition, the operational structure of MDBs probably currently isn't fully working towards this more high-level aggregated cross-region or multi-project platform approach. But if we are to tackle emissions in the largest economy at a space and scale that is needed with the support of institutional investors and sort of the largest pockets of international capital, we really need to start bringing that group together and create initiatives and instruments that are very focused on these bigger pieces of the challenge. And I think that's still relatively early stage, and we hope that the discussion around the role of catalytic equity is going to move towards that rather than a plethora of smaller initiatives that are all really worthwhile on their own, but maybe struggle to create the pace, scale, recyclability potential that these bigger initiatives create.
Right. Thank you so much, Daryl. Yeah, I think, as you said, all players, and I think that comes out actually, I think from all of you, really the importance of getting everyone across the ecosystem. And yeah, still early stage, but at the same time, thinking about how can you really go towards this, the right instruments that can use all the different players most effectively. And Rodrigo, that actually brings me to you again. I think both in our report, but also in this discussion here, I think we are emphasizing the need for strong partnerships between equity providers, between development finance institutions and banks. So just again, from your perspectives, what types of collaboration or like maybe, types of partnerships offer the greatest opportunities to really mobilize private capital at scale for clean energy in emerging markets? So any thoughts on that?
No, I think, well, the fact that this is a new team in HFEC, and the name is Strategic Financing Partnership. So really believe that that's the way to do it. And I think, the thing is, there's no secret, like silver bullet or anything, but I will highlight very quickly three things in my mind, which is, clarity, trust, and engagement, right? Clarity is even from each of the investors, be very clear, even from ourselves, right? We are developing, we have developed our investment principles. So we can go and really quickly tell, okay, these are our 5 drivers of what are the type of investments and transactions we are going to get into. So everyone knows. And I think, that clarity from everyone around the table is a really, really important. The other thing is actually kind of like, be clear on what the clarity on what it will take to actually do that. There's a lot of wishful thinking, right? And there's a lot of pitches there, right? That say, yeah, we're going to do this, but when you start like pushing on what that will take and how much of these things are not part or in the realm of the GP or the manager, but actually things that are around you, you start like, so that clarity and that realism, I think, is important. The second one is trust, right? As in every relationship, partnership, I'm not risking anything, but it's very important that I can have that conversation, be open, honest, right? Tell us things when we don't like it, things and all that. And the third one, I think, Barbara, and I think everyone, Marco, Dario, and also everyone has said engagement. These are hard things to do. One of the reasons why they don't happen more is because they are hard, right? So I will not, it's an obvious, but it's not that, okay, we go there. So, and I totally agree with Dario that basically we should get to a scalable stuff, right? But that means that also each of us has to engage in these things. It's not that we just put money there and then we hope that things go well. I think, there's a lot of engagement, but also obviously respecting each of our roles. So I think, clarity, trust, and engagement to me are key elements of partnership for equity. I'm pretty much for everything, I would say.
Couldn't agree more, Rodrigo. I think that's great. And I think Jared even comes back to some of the points that Marco made around like, templates or like more generally kind of having the standards behind. But I think very, very helpful to know. Thank you so much. I can see that there's a number of questions. I know that the teams are replying to some of those in the chat, but I wanted to come to one of the questions and just see whether my panel, and if you want, you can all turn your cameras on so we have a quick kind of like joint session here. And maybe that, what I see from one of the questions from Chris Woolhouse is that coming back to the focus on platforms, and there's a question around, based on their experience, that the message is that investment-ready pipelines are not there, and there's a mismatch between investment ambition and bankable pipeline. So just love to hear from you whether you agree on that or what you see as the main obstacles or solutions, and really thinking about how to address also not only the real risks, but also the perception of risks. So maybe, Marco, I start with you and then just see whether others have any reflections on that.
Thanks. And it's a great point. And to Rodrigo's point, it takes time. It's hard. It's really hard to develop assets from scratch. And it takes grit and patience and hard work, and sometimes it doesn't go well. But it's needed and somebody has to do it. And so that's why we're backing, on the ground, those who are doing it. Now, the point is at different stages, how do you put things together? So, a couple of things we've done. We used to have different balance sheet in Africa and Asia. We brought them together and we're segmenting them now with the more operational assets in a way that they can see things so that, new initiatives can be investable. I think that's one part that is important. The other thing which I'm seeing is regional platforms. So regional platforms of developers, or better, developers that are targeting specific regions, because while every country is different, especially in Africa, or even states in India, then you've got some similarity and proximity pays. So I think regional platforms, they don't help the concentration at the fund level later on, but they accelerate, taking projects to operation. So I think these are the two things that I'm seeing. So we need to build faster by doing that in multiple projects, and this is better done in the region, and then aggregate across regions to diversify risk when things are operational.
Fantastic. Thank you so much. Just seeing whether any other reflections from the panelists. Otherwise, I'll give you a final question from my end. But Rodrigo, I can see you.
No. I think, the other thing is the platform could be also, there's a lot of initiatives, and I think that Marco said, right? APG in Asia, right? We have things like, power energy in Africa. And I think, plugging these things to those are relevant as well. I agree with Marco that, and again, we need a lot also government sponsorship in some of these things, right? So I think, connecting those and connecting the dots are very important. Like things like the business investment platform Brazil is actually taking on also, right? So find those things. This is what a country platforms actually mean. It's not all like that, actually connecting demand and supply, right? So just that.
Absolutely. Thank you so much. So just as we're getting closer to an end, but I'd like to have one very quick reply from all my panelists here. Just again, we are at the beginning of the year. We have managed, I think, through this work here and all the work that you're doing to put equity and catalytic equity on the agenda. What is the one thing that you would like to see happen? Or what is the one thing that you think could really unlock more focus and then ultimately, hopefully, a use of equity or catalytic equity going forward? And again, you can also obviously repeat, some of the key point that you wanted to make in your previous interventions, but I'd just like to hear kind of, Christmas is over, but if there is like a Christmas wish that you have, what would it be? And maybe, Dario, maybe I'll start with you.
I think from the research, it's clear that the UN GCF plays quite a unique role in its mandate and the amount of equity it's been able to deploy. And it's clearly an institution that already has had a great impact, but also a complex history. And I know there's a lot of thinking that's going into its reform and how it can work faster. And so generally just seeing the GCF be able to continue to grow its impact, work faster, work more quickly with the, from an interaction with the countries and the private sector partners perspective, that would all be really great to see. It's been an important partner to us. And as I said, I think its impact to date is quite unique. So in absence of being able to wish for 10 more GCFs, I just wish the one that exists a even brighter future.
Thank you so much. Please, I don't think like new institutions, let's just scale the ones that you have, but yes, great point, Daria. And Marco, over to you, and then Rodrigo, and then I'd love to see whether Mary and Ahmed also have any final reflections on that before we close. So Marco.
It's been hard to see some of the partners with whom we work retreat because there's not enough catalytic finance. And so really my wish for the year is that as the importance of this aspect and the early stage project development is recognized, then there's a serious effort to put more money there, because behind these portfolios, there are entrepreneurs who need that capital to start, and we need to put the capital there. So that's my wish for the year, that it increases at least tenfold this year, and it goes there fast so that these people can do what they do best, which is get things off the ground.
Great, tenfold. I like that. Let's put some figures out there. Rodrigo, over to you.
Very quickly, for me, we need to unionize more ourselves, right? I think we have a lot of practitioners, and we want to do the same thing. We need to come to the hub to create more hubs, more catalytic, hubs. And I think, also if we are all coming together, probably we're going to have a stronger voice, right? In order to demand the sort of like enabling environment that we need. So I think, for us, practitioners doing this coming together more often and then, voicing these things, I think it's going to be very relevant. So hopefully we can do that.
Fantastic. Thanks so much. Let me hand over Ahmed to you and then Mary for final points before I try to sum up very quickly.
I loved Marco's 10x ambition, and I'm gonna endorse that and double down on that one.
Fantastic. Mary.
Just to say thank you so much to everyone for participating. I think this is a great way to start the new year with a big focus on equity financing.
Fantastic. Thank you so much to all of you. I think we have started, Ahmed, you said at beginning of the year, equity is the beginning of the capital formation. We are hopeful it's early days, but let me just stress, with crisis comes opportunity. I think this work here has really shown the opportunity of doing more with less, of how we can really address the gap, but also like really harness the huge potential of equity and catalytic equity as a powerful tool to mobilize capital and also have additional benefits. So I think let's continue to build the evidence base, let's continue to bring practitioners together, let's continue to look at the pilots and the demonstration effects that all of you and others are doing, but really think about how can we then go from those pilots to scale. I think what I've heard, like one of the key points here, certainly I've heard go from projects to platforms, to regional platforms, think about the whole ecosystem and really how can we use all stakeholders, bring them together, how can we harness the role of governments in really driving this agenda as well. And maybe just ending on, I think Marco, you said it's a lonely space, but there's so much potential. So please join us all in like drawing more attention to this powerful instrument working together that we really can help to fill the climate financing gap in emerging markets and around the world. So thank you so much to all of you. Thank you to all the partners, panelists, and really appreciate having you with us at the beginning of the year. Thank you very much. Have a great afternoon, evening, wherever you are.
Great, thank you.
Thank you. Thank you, Barbara. Thank you, team. Thanks, everybody. Bye-bye.